Hi, you're watching Investor Insights, and in this video I'm going to be talking about targeting orders. Now, I've made videos before about stop loss orders and how you're supposed to use them to protect your capital or to lock in your profits. Now, a target order is simply an order that you put with your initial entry point into a stock or position, whatever instrument that you're trading or investing in, to basically lock in your profit when the price gets to where you want it to be. It deals a lot more with expectation and mindset than anything else. You got to forget about what other people tell you. You don't want to be a lemming. You don't expect every stock to be a blue sky potential stock. You have to have realistic expectations. And it more all comes down to how the economy is going, or what your research has led you to believe that this stock is going to do. And I think the most important point is, will you be happy at that exit point? Now, that last factor that I mentioned is purely subjective. I mean, you can buy a stock at $10 and it goes to 20, but you actually wanted to go to 50. You're not going to be happy at all. But if you buy a stock at $10 and it goes to 20 and your expectation was 15, then you're going to be ecstatic. But the most important thing to consider with those two situations is, at least you're in the money. So if you set yourself an expectation for a stock, it's important to look at the past history and how it's performed during periods of similar growth or expansion. And you've got to make your current evaluation or expectation based on past performance, or from what you know the economy is going to do in the near future. So if you buy something at $10 and you wanted to return, say, 50% over the next year, good luck. And you're not sure how the economy is going, the growth environment, but somehow your expectation is 50%, and you set your target expectation to be $15, well, I'm going to tell you now, you're going to be disappointed. You have to set realistic targets. Now, anything above the rate of inflation will be considered to be a victory. So if you buy something at $10 and it goes to $12 and you've got a 5% inflation rate, it means that you still made 15 real percentage points. That's a good rate of return for a year. And if it gets there, you shouldn't hesitate to take it. Unless, of course, you can see it going even higher. And therein lies further expectations. It's a never-ending game. I would personally ask myself the simple question the day you execute the order: what you want it to be at, and if it gets there, you're going to be happy taking it. So many occasions I would ask people, okay, if you were to buy this at $10 and it got to 13, would you be happy to leave? And they would instantly say, oh yeah, I'm happy taking 30%. But yet, when they do that and gets to 13, their mentality's changed and they want 15. And it becomes unrealistic. And when the stock reverses, they didn't lock in their profits, and they're just befuddled as to what's actually happened and why they didn't make as much money as they should have. In fact, the position might even turn into a loss. And then they're even more upset. So make sure with every investment, every trade you execute, to put a target order, a realistic one, and be happy with it when it gets there. It doesn't matter if it's a day or 2 or 6 months or a year. If it reaches your target, you should be happy about it, and you should walk away, and you can live to fight another day. Any trade that's profitable is a good trade. Set realistic targets, and you can't go wrong. But if you see that the stock is exploding for the right reasons, so the fundamentals are good, the economic factors are driving up the stock, unemployment's low, inflation's low, man, raise your target price. Feel optimistic? Raise them even more. But at the same time, put up your stop losses or your trailing stop loss. You got to be able to lock in the profits that you've already made. Let the winners run. There's nothing, I will not tell you to sell something if you believe and you can explain to me why you believe it's going to go even further. Now, if it's going up because of Fed monetary policy, if it's a distorted market and you're piling in and the technicals still look higher and the fundamentals have just been totally ignored, man, you got to keep both types of stops on those trades, because one way or the other you're going to get crushed, either by being the bigger or the biggest fool or trying to catch a falling knife. Either way. So take that into consideration when you execute your next trade. Keep tight stops and keep reasonable expectations and thus good target prices. So until next time, happy trading.